Welcome to the deep dive. Today, we're really focusing in on dividend investing, trying to make sense of it all for you.
Yeah, we've got some great stuff to work with. There's this detailed PDF, the Dividend Investing Masterclass, and two video transcripts from Dividendology.
Right, the Dividend Tsunami in 2025, one, and also their How to Start Dividend Investing for Beginners guide. Pretty solid sources.
And our goal here really is just to pull out those key ideas, the fundamentals, the different strategies,
Yeah,
help you understand what actually matters.
exactly. Because the info ranges, doesn't it? From the
Yeah,
real basics right up to like valuing stocks and even the tax side of things.
for sure. So hopefully wherever you are on your investing path, you'll find something useful here.
Okay, let's dive in then. Where should we start?
Well, I think maybe breaking down the main types of dividend investing makes sense first. Our sources seem to highlight three key approaches.
Okay. First up is high yield dividend investing.
Right. This is pretty straightforward. It's all about getting as much income as you can, like right now.
The example given is Verizon, VZ. Their yields historically have looked pretty good, ranging from what, over 4% up to maybe 6.5% projected for 2025. That's a decent chunk of change coming in.
It is. But, and this is a big but that both the Masterclass and the Tsunami video point out, you have to look at the growth. Verizon's dividend growth, it's been really low, like under 2% per year on average for the last decade.
Okay, so what's the catch for you, the listener? Well, you get cash now, yeah, but the amount Verizon pays isn't really going up much. It might even lag behind inflation.
Exactly. So that high yield can be tempting, but if the dividend isn't growing or sustainable, it could be what they call a yield trap, something to watch out for.
Right, makes sense. What's next?
Then the sources mentioned, maybe a bit more briefly, defensive dividend investing.
Defensive. Okay, so that sounds like safety first.
Pretty much. Keeping your capital safe, low risk.
Yeah.
Think stable, mature companies, utilities, maybe some consumer staples. Predictable cash flow, but probably lower growth.
So this might appeal more to someone maybe closer to retirement or already retired who just wants stability over everything else.
That seems to be the idea, yeah. The materials don't dwell on it as much, though.
Which brings us to the third type, and this feels like a big focus, especially in those Dividendology videos, dividend growth investing.
Yes, definitely. This is more of a long game strategy. You're aiming to maximize your dividend income and your total returns, but over a longer period.
And the example here is Domino's Pizza, DMZ, which is
Yeah.
interesting because their current yield, I mean, it's projected around 1.35% for 2025. That's not high at all.
Not high now. But here's the kicker. Their 10-year dividend growth rate, it's over 177%. That's huge.
Wow. Okay. So the power isn't just the rising payout itself, but it's like a signal, right? A signal of a really healthy, growing business.
Exactly. It suggests the company's doing well, expanding, and likely rewarding shareholders in other ways too, like share price appreciation over time.
Okay. That focus on growth,
Mm,
it leads us somewhere else important, doesn't it? This idea of yield on cost.
it does, yeah. Yield on cost. It's maybe a slightly different way to look at your return.
So break that down. What is yield on cost exactly?
It's basically measuring the income you're getting now based on what you originally paid for the stock. Not the current price, but your initial investment. It shows how your income stream has grown relative to your starting point.
And the Dividend Tsunami video uses Broadcom AVGO for this.
Right. Great example. Back in, what was it, 2013, Broadcom's yield was maybe just over 2%. So $1,000 invested would give you about $21 in dividends. Not much to write home about.
Yeah. Hardly seems worth it initially.
But then you look 10 years later, 2023. Broadcom's dividend had grown so much that the same $1,000 investment was now paying out over $516 a year.
$516 from an initial $21.
Yeah.
That's a yield on cost of over 51%.
Incredible, isn't it? It really highlights the compounding effect of dividend growth if you stick with it.
And the comparison they made. After just 10 years, Domino's yield on cost actually overtook Verizon's, even though Verizon started way higher.
That's right. Patience is key in dividend growth investing, clearly.
Okay, so patience pays off. Now, the Masterclass PDF talks about a dividend growth pyramid. Sounds like a helpful visual.
It is, yeah. It sort of categorizes dividend stocks based on two things, their growth rate and their current yield.
So at the top of this pyramid, what do we find?
That's where you typically see companies with really high dividend growth, but maybe lower starting yields. The video mentioned names like Costco, Visa, Lowe's. Remember Visa's nearly 177% growth rate? That
Oh.
fits up there.
Okay, high growth, low yield at the top. And then as you move down,
You start seeing companies with higher current yields, but their dividends tend to grow more slowly. Realty income, the REIT ticker O, often gets put in these lower, higher-yielding tiers.
So it's not like you just pick one spot on the pyramid and stay there forever, right?
No, not at all. It really depends on you. Your time horizon, how long you plan to invest, your goals, your tolerance for risk.
Right. Someone younger might focus higher up the pyramid initially.
Exactly. Going for that growth. Whereas someone closer to retirement might shift towards the lower tiers, prioritizing that immediate higher income. Your strategy can and probably should evolve.
That makes a lot of sense. Okay, so if we're going to do this, we need to know what to look for in a company. The sources highlight some key metrics. What are the real must-know numbers for dividend investors?
The Dividend Tsunami video really hammers home 5 key ones. First, and maybe most important, free cash flow, or FCF.
FCF, right. That's the actual cash left over after a company pays its bills and reinvests in the business. The video had a good analogy. It's like what's left in your bank account after your bills are paid.
It's a great analogy because it emphasizes that FCF is real cash. Earnings can sometimes be, let's say, managed through accounting rules. FCF is much harder to fudge.
Yeah, they mentioned cases like GE, Amazon, Boeing, where earnings maybe didn't tell the whole story, but FCF gave a clearer picture.
Exactly. So FCF is number 1. Next is dividend yield.
Okay, that one's simpler. Annual dividend divided by the current stock price tells you your immediate income return.
Then, payout ratio. This is key. It's the percentage of earnings, or even better, the percentage of free cash flow that's paid out as dividends.
And the video stresses using the FCF payout ratio, right, as a more reliable measure.
Definitely, because FCF is that real cash. The PDF even warns, the FCF payout ratio is climbing, but FCF itself isn't growing much. That could be a red flag. Maybe the dividend growth isn't sustainable.
We saw Domino's FCF payout was around 41% in 2024. Seems reasonable, paying out a good chunk, but keeping plenty back.
Exactly. It leaves room for reinvestment and future growth. Okay, number 4 is the dividend growth rate itself, usually shown as KGR, compound annual growth rate.
So how fast has the dividend actually been increasing, say, over the last 5 or 10 years?
Right. And finally, number 5 is dividend history, just the company's track record. Have they paid consistently? Has they grown it consistently?
A long history of increases is usually a pretty good sign.
A very good sign. Now, knowing these metrics leads us to something really crucial: capital allocation. The video called it the single most important task of any management team.
Okay, capital allocation. So what does a company do with all that free cash flow we were just talking about?
Well, there are basically 5 main options. They can reinvest it back into their own business organic growth. They can buy other companies, mergers and acquisitions, M&A.
Right.
They can pay down debt. They can buy back their own shares. Or 5th, they can pay it out to shareholders as dividends.
And as investors, especially dividend investors, we really need to understand how a company prioritizes those choices.
Absolutely. The video says, look at investor presentations. Companies often spell out their capital allocation strategy there.
Like the examples given, Johnson & Johnson putting reinvestment first, then dividends second.
Yeah, or Visa focusing on growth first, then aiming to return, 25% of earnings per share via dividends and buybacks. It tells you a lot about their priorities.
And for dividend growth investors, a healthy FCF payout ratio is good because it means there's cash left for the reinvestment, right?
Yeah.
Like we saw with Domino's, their FCF grew massively alongside their dividend.
Precisely. But there's a flip side. The video used IBM as a cautionary tale. Dividends kept going up, but FCF was actually declining.
So the payout ratio was rising, making the dividend look less sustainable long-term unless FCF turned around.
Exactly. It's a warning sign.
So dividend growth, it's telling us more than just my check is getting bigger. It reflects the company's underlying health.
Absolutely. It signals financial strengths. It signals management's confidence in the future. I mean, think about it. You wouldn't aggressively raise your dividend if you weren't pretty sure you could afford it down the line.
Exactly. Good point. And the video mentioned it forces discipline too. Makes management really focus on high return projects because that dividend cash isn't available for maybe less certain ventures.
That's a key point. And maybe most importantly for us over the long haul, it helps combat inflation. The cost of living goes up. The video showed how even 2% inflation adds up massively over 30 years. Dividend growth can help your income keep pace or even outpace it.
Yeah, and that Harvard Fund study they mentioned, dividend growers significantly outperforming since 1980, that's pretty compelling evidence.
It is. Though it's important to remember the correlation versus causation point the video made. It's not just the dividend growth causing the outperformance.
Right. It's that the companies able to consistently grow dividends are usually high-quality businesses that are also growing their underlying free cash flow and profits,
Okay,
like Visa's FCF growth alongside its dividend growth.
exactly. The dividend growth is often a symptom of a healthy, growing business.
Okay, now, we all know markets go up and down, sometimes way down. How does this dividend growth approach help navigate market volatility?
Well, the Tsunami video looked at historical S&P 500 returns. You see those big down years, 2022, 2008, the early 2000s.
Yeah, nobody likes seeing those negative numbers.
And it highlights something called sequence risk, which is a big deal if you're near or in retirement. Bad returns early on can really hurt how long your money lasts.
That's a scary thought. So how do dividends help?
The interesting thing is, even in those years when the S&P 500 overall lost value, the total dividends paid by S&P 500 companies often still went up.
Oh, really? So the income stream was more stable than the market price?
Generally, yes. And dividend growth ETFs, like the SCD example they used, also tend to show pretty consistent dividend growth over time, even through downturns.
So those dividends provide a bit of a buffer, and maybe reinvesting them when prices are low could even be an advantage.
That's the idea. Buying more shares at lower prices with your dividends can potentially boost your future returns. Plus, the video noted that dividend growth stocks historically tend to fall less, on average, during bear markets compared to non-dividend payers.
Okay, that's definitely encouraging. Let's maybe switch gears slightly and look at some specific income opportunities the sources covered, starting with REITs, real estate investment trusts.
All right, REITs. They're often known for higher yields. The VCI Properties example, VZI, had a starting yield over 5% and decent growth, too.
And the Masterclass PDF explained their structure, right? They have to pick out most of their taxable income, like 90% as dividends. That's why the yields are often higher.
It is. But that also means they might have less cash left over for growth. So, as noted with VZI having more shares outstanding over time, they might need to borrow money or issue new shares to expand, which is something you need to watch.
So with REITs, you can't just look at the yield. You really have to dig into the quality of their properties and, importantly, their tenants, like the examples Realty Income or Agree Realty showing their top tenants. You need that rent to be reliable.
Absolutely. And the key metric for dividend safety in REITs isn't the standard earnings payout ratio. It's AFO adjusted funds from operations.
AFO, right. The Masterclass explained that and why the FFO payout ratio, like the example for Agree Realty, gives a much better picture of whether the cash flow actually covers the dividend.
Exactly. It's a crucial metric for REIT investors.
Okay. Another area getting attention is covered call ETFs. How do those work?
So these ETFs hold stocks, but they also sell call options on those stocks. Selling the option generates income, the premium.
So the appeal is higher income, maybe some downside protection, convenience.
All of the above, potentially. You see ETFs like JPI, QALD, space Y I mentioned, often with yields that look much higher than the overall market.
But there are trade-offs, always trade-offs. The video mentioned limited upside.
Right. Because if the stocks go up too much above the option strike price, the ETF might have to sell the shares, capping your potential gains.
And the monthly payouts aren't guaranteed to be the same each month, are they? Like JPI's history showed variation.
Correct. Payouts can fluctuate. Market volatility plays a role too. Higher volatility can mean higher option premiums, potentially leading to higher payouts, but also more risk.
The video also touched on option terms like in the money or out of the money calls.
Yeah, and how much of the portfolio they write options on the coverage. A fund writing calls on 100% of its assets will behave differently yield-wise and upside-wise than one writing on, say, 50%, like the SPYI example.
And a really crucial point seems to be taxes. The video highlighted big differences between funds like JPI and SPYI. Some pay unqualified dividends.
Yes, and that's a big deal because unqualified dividends are taxed at your ordinary income rate, not the potentially lower qualified dividend rates, something you absolutely need to check before investing.
Definitely. Okay, moving away from specific strategies. How do we identify companies with real staying power, those competitive advantages?
The Tsunami video suggests looking at the fundamentals again. Strong advantages often show up in the numbers.
Like what kind of numbers?
Well, return on invested capital, ROIC, was one. Altria Group, MO, is the example. Consistently high ROIC suggests they're very profitable with the money they invest in the business.
Okay. And the other one mentioned was gross profit ratio as a sign of pricing power.
Exactly. Altria's ratio is increasing, suggesting they could raise prices or manage costs well enough to keep strong margins. These metrics can hint at a durable business.
It's interesting, too, thinking about the role of dividends in really top companies. Sometimes you think high-growth tech maybe doesn't do dividends.
But the Meta Platforms example, Meta, is fascinating. Huge growth, tons of cash, drowning in cash, as the video put it, historically no dividend. But they started one in 2024.
And the point about their Reality Labs spending, lots of cash going out, not much clear return yet. It kind of highlights that maybe allocating some cash back to shareholders via dividends makes sense when reinvestment options aren't all slam dunks.
Precisely. When a company generates more cash than it can profitably reinvest, dividends become a very sensible way to return value. Microsoft is another example, started paying dividends back in '03, huge FCF and dividend growth since then, alongside amazing market performance.
Okay. Now, what about the whole share buybacks versus dividends debate? Companies returning cash in different ways.
Right. Buybacks reduce the share count, which can boost things like earnings per share. Apple's massive buyback program is the classic example.
But dividends are maybe more predictable for income seekers. The video used ADM for that.
Yeah, dividends tend to be a more stable, reliable income stream. Buybacks can be more opportunistic, and importantly, they only really add value if the company buys back shares when they're undervalued.
If they buy back overpriced stock, it actually hurts shareholders.
Correct. And there's also that potential issue the video raised about management incentives. If bonuses are tied to EPS, buybacks might be favored even if dividends or reinvestment would be better for long-term value.
Good points. Okay, regardless of the strategy, something that always comes up is diversification.
Absolutely critical. Don't put all your eggs in one basket. The video mentioned a rule of thumb, maybe 12 to 30 stocks.
Yeah, something like that. But not just the number of stocks, right? Diversifying across different sectors is key, too. Don't want everything in tech or everything in energy.
Exactly. And the video made a really smart point about diversifying your dividend income source, too. You might have 20 stocks, but if 80% of your dividend income comes from just one sector, that's still a concentration risk for your income stream.
Huh, that's a good nuance. Diversify the holdings and the income sources. Okay, almost there. Valuation. We can't forget valuation. Paying too much kills returns. Even for great companies. Warren Buffett's famous line.
So true. The video gave a quick overview of 3 models relevant for dividend investors.
First was dividend yield theory, the idea that yield reverts to its average.
Yeah, simple concept. Look at the current yield versus its history. But the video rightly pointed out its limits. Like with Broadcom, a company can fundamentally change, meaning its average yield might not be relevant anymore.
Okay. Then there was Bogle's valuation model.
Right. Expected return earnings growth plus shareholder yield, that's dividend yield plus buyback yield, plus or minus changes in the valuation multiple. The Domino's example walked through how you might estimate a potential return using those components.
So if you assume, say, 10% earnings growth and a 2% shareholder yield and no big change in the PE multiple, you might expect around a 12% return. Something like that.
That's the basic idea, yes. It combines growth and direct returns.
And the third one was the dividend discount model, DDM.
This one's a bit more complex, maybe. It tries to value the stock based on the present value of all its expected future dividend payments, discounting future cash back to today's value. The waste management example showed it can sometimes get you close to the current price.
Okay. And they mentioned other methods, too, like discounted cash flow, just briefly.
Yeah, just acknowledging there are other ways to think about valuation.
All right, last big topic, and it's a crucial one. Tax implications. There seems to be a misconception out there.
Definitely. The Tsunami video tackled it head-on, this idea that dividends are always tax inefficient.
First off, retirement accounts, right? Like 401ks, IRAs.
Yeah.
Dividends inside those often grow tax-deferred or tax-free, depending on the account type.
Huge benefit right there.
Yeah.
But even in a regular taxable account, the concept of qualified dividends is key.
Qualified dividends. Okay, explain that again.
So for many dividends from regular U.S. companies and some foreign ones, they get taxed at lower long-term capital gains rates. And the video highlighted that for 2025, if you're married filing jointly and your taxable income is below about $96,700.
The federal tax rate on those qualified dividends could be 0.
0%, yes. It's a pretty high threshold, meaning you could potentially earn a significant amount of dividend income completely tax-free at the federal level. Single filers have a lower threshold, but still substantial.
And they compared that to salary income, right? Getting $100,000 in qualified dividends tax-free is way better than a $100,000 salary that gets hit with income tax and FICA taxes.
Exactly. Plus, dividends aren't subject to FICA taxes, and many states don't tax them either. Even if you have other income pushing you into higher brackets, the qualified dividends below that threshold can still be tax-free, and those above it are often taxed at 15%, which is still usually lower than ordinary income rates.
But the key is qualified, right? Because things like REIT dividends, or from BDCs, or some of those covered call ETFs, those are often unqualified.
Correct. And unqualified dividends get taxed as ordinary income right from the first dollar. So you really need to know whether the dividends you expect are qualified or not for tax planning.
Wow. Okay, that was a lot. We've gone from the basic types of dividend investing through yield on cost, the pyramid, key metrics like FCF,
Capital allocation, why dividend growth matters, handling volatility, looking at REITs and covered calls,
identifying competitive advantages, the role of dividends even in growers like Meta and Microsoft, buybacks versus dividends, diversification.
valuation basics, and finishing up with those really important tax considerations.
Yeah, it really feels like the bottom line here is dividend investing isn't just one thing. But if you understand the different approaches, the metrics, the context, it can be a really powerful tool for building wealth and generating income over the long term.
Absolutely. It requires some thought and strategy, but the potential rewards are definitely there.
Well, hopefully this deep dive has given you a solid foundation or maybe some new things to think about.
Yeah, definitely encourage everyone to keep learning. Thanks for joining us today.